Good afternoon, everyone. My name is Bishesh Shrestha, and I'm a senior loan officer with Live Oak Bank. Today, I'll be speaking to you about self-storage financing. During my presentation, we'll be focusing primarily on SBA financing and what to expect when you're seeking out these loan products with the bank. The presentation will also provide some insight into what banks look for in a borrowing candidate, and also the terms and conditions that are applicable to these loan programs. Now, before we dive into our main topic, I'd like to give you all a little background about the bank, our self-storage team here in the bank, and myself. So who is Live Oak Bank? We are the #1 SBA 7A lenders in the country. We have a national footprint. We lend in all 50 states and US territories, but we operate out of Wilmington, North Carolina. That is where HQ is. And we've got about 600 employees that work from Wilmington, North Carolina. We are FDIC insured bank, and we got started in the best time of it all in 2008. But given our unique lending model, we've been very successful in the past decade or more of operation. We've done about 9,200 loans since inception, amounting to a little close to $13 billion worth of financing. Now, our unique lending model is based on our specialization. Our lending is highly focused, highly specialized. We don't lend to anyone and everyone out there. We have about 30 very specific industries, 30 plus. I think it's growing every so often. So 30 plus industries that we lend to, and that's it. And each industry that we lend to, we have a hyper focus on that industry. So for example, on the self-storage side, my job as a lender is to only look at self-storage projects, self-storage transactions. So that's what I do all day, every day. My underwriting team, my credit officers, my loan closing specialists, my construction relationship managers are all focused on self-storage. So with that kind of focus, we have a lot of expertise and experience in this industry. So we do take an educational approach to folks who are coming to us for financing. So we do understand that it could be your first time that you're coming in to get a self-storage loan, first time as a self-storage owner operator, first time an SBA candidate. So we have all the experience and expertise given our specialization, and we transfer that over to our borrowers. So our borrowers get a lot of information beforehand and throughout the process, so they know exactly what they're getting into. And like I said, we are headquartered here in Wilmington, North Carolina. We don't have any branches, so we do actually fly out to meet people face to face and set our eyes on the project that we'll be financing. So we do have that person-to-person contact. That way, we're talking to them directly. They know who we are. They know who they're talking to on the other line of the phone or the email. So we have a very budding relationship when we're going through a loan application. We are a NASDAQ listed company. We went public in 2015, and the self-storage team has done an exceptional job. And we've been the winners of the Inside Self-Storage Lender of the Year for 5 years running. On a side note, that facility that you see there, the picture of the facility is in Arizona. This was financed through Live Oak Bank as well. And it was the Facility of the Year in 2019. So looks really nice. Very proud of that project. So the self-storage lending team. Now, Live Oak began exploring the self-storage industry early 2015. And by the end of it, we were actively lending in that space. Timing was perfect because the self-storage industry was on an uptick, and the the business volume has been exponential. So far, we are the #1 SBA 7A lender to the self-storage industry. We've done quite a bit of loans, as you can see there, $700 million since the inception of this vertical in 2015. Nearly 350 loans closed. Since 2015, average loan size falls to about $2 million. So we've been busy for the past couple of years. As for me, I joined Live Oak in 2013. And I joined the self-storage team in 2016, right when it got started. So I've had a great time learning about this industry, operating in this industry. I've helped finance over $200 million personally in the self-storage industry. So have learned a whole lot in the past couple of years. And while I was helping people, I realized this is an amazing industry, and I should be actively an active participant in this space. So I actually invested in 2019 with a group of other people, partners, in 2 self-storage facilities, one in Alabama, one in Tennessee. So I'm now, apart from just a lender in the space, I'm an owner as well. So let's dive into the lending options that you may have with Live Oak Bank. The SBA 7A, we'll be diving into that. The SBA 504, and the conventional loan. Now, conventional, we'll leave it. There's another breakout session that'll discuss that. I think Adam Carnes with the BSC group will probably be providing more color and details on that. But for today, we'll be discussing the SBA 7A program as well as the SBA 504. Both those products are very popular in the self-storage space. People use it to buy self-storage facilities, build ground-up construction, startup projects, or expand their existing structures, or add amenities like portables, or do CapEx. So the SBA program, be it 7A or 504, is very popular in the self-storage industry. Now, what is the SBA? So the SBA, or the Small Business Administration, is an organization that provides capital to small business owners and operators. Now, recently in the news, you may have heard about the SBA for the involvement with the Payroll Protection Program, but this organization has been actively providing capital to small business owners since 1953. Now, the caveat here is the SBA deemed self-storage ineligible until very recently. So in 2010, they allowed, in the height of the recession, they allowed self-storage to become eligible for financing under the SBA program. Now, what happened in 2010 was good and bad. Good because SBA allowed SBA financing to be eligible for self-storage. Bad because everyone, all banks in the country and all borrowers who needed capital swarmed for the SBA products. Now, any bank in the country can make an SBA loan. That doesn't mean that all of them know how to make an SBA loan. So there was a lot of demand, and boom, the banks could not execute. So there was a lot of fatigue, just document fatigue, process fatigue, all of it. And that's when a lot of people just backed away because it was just too tedious. But the catch there was there were banks that were doing SBA loans that had never done SBA before, and they fumbled. So it's very important to understand who you're dealing with. The SBA has what we call a preferred lender program, PLP, we call it in the industry. And if the banks have a preferred lender status, that means that they can process, at least for the SBA 7A loans, process the application in-house. That means they can take in the application, they can approve the application, and they can close the loan in-house without ever having to reach out to the SBA. So what that does is, if if a lender has a PLP status, your application process has a chance of being executed, has the chance of being processed 3 to 4 weeks faster than an organization that does not have a PLP status. So when you go to banks, you have to ask them, are you a preferred lender with the SBA? That's the step one. Step two would be ask them how many SBA loans do they do in a year. Third question, do you guys do self-storage loans under the SBA program? These are some questions that you definitely need to ask your lender when you approach them for a self-storage project. Self-storage, unlike other asset classes, is tough for some of the banks to understand. So it is better to pose those questions in the front so you don't have an excruciating experience down the road. Now, the SBA 7A program is what we're going to discuss first. And this program has been a darling when it comes to self-storage. So the SBA 7A program can be used to acquire, build, construct, start up, expand, or refinance a self-storage project. The best characteristic of this program is its high leverage potential. We can go up to 90% loan to cost on this deal. And we're going to discuss how the 90% loan to cost is calculated, but 90% leverage is possible through this SBA 7A program. The leverage can be even higher than 90% if it's an expansion play. Now, all the leverage determination comes down to cash flow. We use cash flow to determine exactly how much we're going to lend on a particular project. Leverage is good, but at the end of the day, the business has to be able to support that debt payment. So cash flow is how we determine exactly how much we can lever up the project. If the deal is strong, we can go up to 90%. Now, as a guarantor on a project, you have about $5 million worth of SBA runway, and that's your total runway. You can do five $1 million loans to get to that $5 million, or you can do one $5 million loan to get to that to use up that runway. If you have, let's say, a $6 million request, you can use a pari passu conventional loan. Pari passu is pretty much a fancy French term for similar terms. So you can use a conventional loan with similar terms as the SBA to meet that additional larger financing request. So if the SBA loan is on a 25-year, the pari passu loan, the conventional loan, will also have to be a 25-year amortization, and all the terms and conditions which we'll cover will have to be same as well. Now, an SBA 7A loan is like a bank loan. And I say that because it's the bank that's lending you the money, right? The SBA only steps in a time of loan loss. So let's say there's an unfortunate situation where this self-storage facility just did not perform, and the bank had to liquidate the asset, and let's say it had a $100 loss. $75 of that loss is covered and guaranteed by the SBA. The bank at that point will have an exposure of $25. So the bank still have some exposure. That exposure is greatly reduced by the guarantee that the SBA provides. Now, it's this guarantee that allows the banks to take a chance on a newcomer to the self-storage industry, provide them the higher leverage so they don't have to liquidate all their cash out of their savings account. So it's that guarantee that makes the banks comfortable to lend in a situation that may be deemed aggressive by conventional lenders, because the conventional lenders do not have a guarantee. They have a full exposure to loss. So let's talk a little bit about that loan to cost that we're talking about. In an SBA 7A program, for an acquisition, let's tackle that. For an acquisition, in that 90% loan to cost, we can include the purchase of a facility. We can cover closing costs, and also provide operating capital. Usually folks take it for CapEx, like fixing the gate, repairing the doors, repairing the roof, maybe new paint, asphalt. We can provide all that in an SBA 7A loan at 90% financing, as long as the cash flow allows it. And we'll discuss cash flow here in a minute, but those are all that can be included as eligible costs for an SBA 7A loan. For development, now here is the really impressive part. For development, an SBA 7A loan can be used to acquire the land, cover construction costs, hard costs, and soft costs. Soft costs being architect and engineering, permitting, etc. We can cover that. We can cover closing costs, and then interest reserve and operating capital. The interest reserve is a set of funds that are used to help with debt payments while your facility is being built. The operating capital is a set of funds that will cover your facility's debt payments and the net operating losses while you're leasing up. So in a best case scenario, with 10% down, you can get a break-even facility within the next 2-3 years, whatever it may be, without having to shell out any additional cash out of your pocket. So that is the beauty of an SBA loan. It gets the project well capitalized, so you're not worried, stressed about, hey, will we have a shortfall? Will I have to put in money from my savings account? None of that. The project will be supported through the loan. Again, the cash flow has to make sense. So let's touch upon the cash flow a little bit. So for acquisitions, we're looking at the cash flow of the facility. Let's say you're trying to go in and acquire a self-storage facility. We'll look at the historical cash flow through its tax returns. Let's say the tax returns indicate a very poorly managed facility. Then we can base our analysis on projections. In the self-storage industry, it is not very uncommon to see a facility that is being acquired that is completely mismanaged. Those numbers look very bad, but we do understand that there's a potential in the market. There's potential in this asset. So we can look at projections, and we can go 90% financing on a projection-based deal. But those projections will be severely vetted. We will want to make sure that the projections make sense. It's not like you come in and say, hey, the facility is doing a revenue of $100,000. I'm going to take it to $600,000 in the first year without any explanation. No, the projections have to be rooted in solid assumptions. So we will dissect that. We will try and understand that. And if the projections make sense, we will provide 90% financing on that acquisition. For construction, where the asset is not there, we have to rely on a feasibility study. So the feasibility study will show us exactly how this facility leases up. And that gets the bank comfortable in, hey, within 24 months, if this facility breaks even on its principal and interest payments, then we're good. And I say that because the SBA has a rule. All the projects that the SBA finances through, all the projects that are financed through the SBA program have to show the ability to break even within 24 months. So for a construction project, that is how we're setting leverage. At how much leverage does this project break even within 24 months? So that 24-month is a crucial key performance indicator. Something to keep in mind. Now, cash flow, again, this is the first step of the cash flow, and there's a second step which we'll discuss here in a couple of minutes. On a regular acquisition deal, you can expect a 25-year fully amortizing loan. It's a 25-year straight shot. There's no calls, balloons, or financial covenants. So you can keep this loan for 25 years if you want. In construction, we allow interest only, and we can allow it for 36 months. So 12 months for construction, and then 24 months after that for lease up. All in all, 36 months. And then we amortize the loan after that at 23 years. So all in all, you get from closing of your loan to maturity about 26 years. And again, like I said, it's fully amortizing, so you can keep this loan for 26 years if you want. If you have a need for interest only during for an acquisition, we can definitely provide that. But that interest only will eat into your amortization. So let's say we provide 6 months of interest only for an acquisition, then your principal and interest payments will be amortized over 24 and a half years after that. Now, the no balloons calls of financial covenants, although that doesn't jump out of the page, it is important to understand that that's a lot of value right there. A lot of conventional loans will have either financial covenants, LTV covenants, or some other form of covenants. And those covenants can come up at the most inopportune times. And that happened in 2008, in that recession. And it might have happened here during the, the pandemic-related recession that we went through a couple of months ago. But noticeably in 2008, where developers had borrowed money to do a project, they were in lease up, they were paying their bills, but all of a sudden the market crashes, the valuations on the property crashes, and now you are out of your LTV covenants. Banks are calling on your loan even though you're making regular payments. And it's very tough in a recession environment to find refinance. So a lot of people had to foreclose on their properties. The banks had to foreclose on the properties, or a lot of people had to declare bankruptcy. So that no balloons calls of financial covenants does carry a lot of weight, although it's not as attractive as discussing maybe the amortization or the interest rate. The prepayment penalty is over 3 years on an SBA 7A loan. And that's 5% in the first year, 3% in the second year, and 1% the third year. Now, let's say you closed on the loan, on an acquisition loan today, and you won the lottery and won $200,000 in a lottery ticket. You can still, on $1 million loan, you can pay down $250,000 the first year and not incur a prepayment charge. So the SBA allows for rapid pay downs, but not rapid pay offs. So the prepayment penalty is 3 years, but in a development situation, that doesn't weigh on the transaction because you're using the first 3 years for construction and lease up anyways. But that is the prepayment on a real estate deal that we see in self-storage. So fees and costs, let's talk about that a little bit. There are no origination fees in this loan program. The bank doesn't charge an origination fee, but the SBA charges a fee for doing this loan, for guaranteeing on this loan. And given the fact that the SBA is a self-sustaining organization that doesn't impact taxpayers, they have to make revenue somehow. And that revenue comes through the 2.5% fee on the loan amount. Now I say 2.5% because it's not a very specific percentage that we can extrapolate right away to determine exactly what your loan fee is going to be. That is a tiered fee structure. So it all depends on how much you borrow. So 0 to 150 will be feed at X%, while 150 to 500, there'll be X% on that. So it grows as the loan amount grows. All SBA loans are full recourse loans. Anyone with 20% or more ownership in a transaction will have to personally guarantee. And there has to be a minimum of 1 guarantor. So let's say there's 10 partners, each with 10% ownership. That is technically below the 20% ownership. So the SBA said, hey, in that situation, a minimum of one person will have to stand up and guarantee on the project. So full recourse is that is required on all SBA loans. So 20% is the number that you need to keep in mind. So let's talk a little bit about the qualifications of the guarantor. Now, this is where the second step of the cash flow comes in. First step being the self-storage, second step being the guarantor. We want to see the guarantors be at 50% debt to income. What that means is if a guarantor has an annual debt payment obligation, let's say mortgage payments, credit cards, car payments, student loans, whatever it may be. If they have annual debt payment obligation of $100, they need to show income, be it W-2, be it distributions, be it 1099, whatever it may be, of $200 to offset it at 50%. So if the self-storage facility's cash flow is in check and the borrower's cash flow is in check through that debt to income ratio at 50%, then we have a deal. Then we look at the credit score. The SBA is vague about the credit score, but each bank will have a minimum. For Live Oak, we have 650 as that number, but that'll depend from bank to bank. The SBA says you cannot be on probation, parole, or incarcerated if you want to be eligible for this loan. And yeah, that we get all that information through all these different reports. So yeah, you cannot be on probation, parole, or incarcerated. The next one is definitely interesting. Given the fact that SBA is a federally run organization, they do not want to see their borrowers default on other government loans prior. So no defaults on other government loans is a requirement. Must be a US citizen or legal resident alien. The rule is 51% of the operating company or the real estate holding company that is doing this transaction has to be owned by US citizens or legal resident aliens. Now, the no bankruptcy rule is specific to Live Oak. The SBA does not have a no bankruptcy rule, but Live Oak Bank does, and some other banking organizations also may have some rules associated with bankruptcy. That's a touchy subject. Now, size standard. Now, that just means that Warren Buffett, if he came down and asked me for an SBA loan, he'd be too big for the SBA. So there are size standards in place that says, hey, this individual or organization that is requesting a loan is too big. And for self-storage, I think if you are a self-storage tycoon, if you have $30 million or more in revenues from self-storage, then you may be too big. Or the personal resources test. This is another one that comes up. Let's say you have a loan request for $1 million and you have $1 million of cash sitting in your checking account. That is a problem. That says you have other options of getting a financing. So the size standards do play in. So definitely, if you feel your net worth or your liquidity could be a concern, definitely have a discussion with your lender to see if you are too big for the SBA. Lastly, on the SBA 7A side, collateral. There are a couple of quirky things that the SBA has in regards to collateral. So even though the loans we can make a loan at 90% loan to cost, we have to be within 85% loan to value. 85% loan to value fully collateralizes this transaction. That's according to the SBA. So we come up with that 85% LTV based on the appraisal. So for an acquisition, we'll look if there's no improvements that are being done on the facility. We are looking at the as-is appraisal and seeing if it's within 85% loan to value. So how you come up with that calculation is if your loan amount is $850,000, then you have to have an as-is appraisal value for your asset that needs to come in at $1 million to be at 85% loan to value. For development, the 85% loan to value is based on the as complete appraisal value. A lot of people get this confused with the as stabilized, but no, it's the as complete appraisal value that we're looking at. And the 85% LTV on the as complete appraisal value, I mean, it's possible because as complete appraisal values are value given to your facility without any tenants in it, as just as built. So a lot of people stress out about, hey, will this appraise? We've had a, knock on wood, we have had a good success rate given the appreciation of self-storage out there in the world. Given people's demand for self-storage, we've been hitting values at 85% LTV, even though we made a loan at 90% loan to cost. So let's say it does come in short. There is a gap. The SBA says, hey, you can look at other couple of things that you can do to shore up the gap without having to reduce the loan or have the borrower come in with cash. And the first thing that they want us to do is look at real estate assets, be it residences or rental units that you may have. Any asset with over 25% equity, we can take a second lien on to bridge the gap. Let's say there's a gap of $100,000. You have a rental home that has $100,000 worth of equity. We just take a second lien on that asset. Boom, we can still do the loan. Now, here's the really quirky part. If you don't have any real estate assets with 25% equity, or if you don't have real estate assets at all, then the SBA says, hey, just bridge the gap with life insurance. So it kind of rewards people for not having real estate assets, I guess, ownership in real estate assets. But it is what the SBA said, and usually first things first, we go tracking the real estate assets, and then if they don't have any real estate assets, or if they don't have any real estate assets with equity, then we jump to option B, which is the life insurance. So that was that for the SBA 7A program. Let's talk a little bit about the SBA 504 program. Now, this gets a little tricky, so I bet there'll be some questions on this one. But yeah, we'll discuss this right here. So the SBA 504 is a public-private partnership. What that means is the bank, the SBA, and the borrower all come together to get this transaction done. The bank, in this case, let's take example of Live Oak Bank. Live Oak will finance 50% of the total project cost. The SBA will put in place 35 to 40%, depending on what type of project it is and what type of borrower profile you have. Will come in with about 35 to 40%, and then the borrower needs to inject or put a down payment of 10 to 15%. So that's the capital stack with a 504. Now, the bank will provide 50% of the total project cost. Projects the 50% will be amortized over 20 to 30 years, but a balloon in 10 years. Most banks will place a balloon. That's the minimum. 10 years is the minimum that you can place a balloon for. So you have a guaranteed term of 10 years, but the amortization can be anywhere between 20 to 30 years. Now, the amortization, some may choose 20 just because they want to build equity a lot faster. Some want the lower payment, so they may opt for 30. I've even heard of banks going up to 32, 33-year amortization. So that all depends on the bank. The interest rate and prepayment penalties are entirely bank dependent, but right now, again, historic lows on the interest rates from the banks too. And the prepayment penalties I've seen anywhere between 3 years to 5 years to 7 years. The SBA debenture portion covers, like I said, 35 to 40% of the total project cost. And depending on what you choose, you have an option to choose either 20 or 25-year fully amortizing debenture. Now, here's the kicker, the low interest rate. When I say low, it's low. For the month of October, they published the debenture rate, and that is at 2.552. Yeah, I repeat, 2.552. So if you can lock in your project 40%, let's say best case situation, 40% of your project at 2.552%, that will bring your weighted average on the entire deal. Even if the bank came in with a 4.75 or 5% interest rate, you'll be in the low fours, if not, in the high threes. So that is the biggest appeal of the SBA 504 loan. Because if you can lock in that debenture at that rate, your debt service is going to be a lot lower. And the SBA debenture has a 10-year prepayment penalty, and that has a very tricky calculation. So usually when I talk to people, I tell them, hey, it's going to be 10%, 9, 8, it decreases 1% every year. And that prepayment begins at closing of the debenture, and that's the 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 on the outstanding interest payable for that particular year that you're paying off. A lot of people choose to keep the debenture in place and may refinance the first mortgage. That is allowed because they want to take advantage of the low interest rate of that debenture, so they'll keep that in place while they refinance the first mortgage after 3 to 5 years. Now, the debenture is set after loan closing. Now, this is key to understand. Your debenture does not set when you close on the bank loan. The debenture is set for an acquisition. Let's discuss that. For an acquisition, maybe a month, 2 months after closing on the deal. And that is just because your project has to go into a pool, and then they bid out the pool and get a debenture rate on that particular project based on the pool it's in. And that usually happens a month or 2 after your deal actually closes. So during that gap, during the month or 2 months, usually the first lien holder, the bank, let's say Live Oak Bank, will provide an interim loan to carry you those 2 months. Most banks provide interim loans, but there are banks that do not. Now, on a construction side, the banks will have to provide an interim loan for 12 to 15 months because the debenture doesn't set until you have CO on your property. That's certificate of occupancy. Once your building's built and it's ready to get going, it's at that point that the SBA debenture sets. So if you're looking at a 2.552% right now, that rate may be very different when you actually go to secure that debenture for your project. These rates are published every month. So you can track it on a 25-year AM or a 20-year AM. You can track it. It's got all the historical data, so you can guess exactly where it's going. For now, it seems like it's staying put, but again, that's speculative at best. But again, these are the historical lows that we're seeing right now. So if there is a sizable acquisition, I usually explore the SBA 504 because that debenture rate really gets the cash flow looking really, really strong. So again, the SBA 7A has its own advantages. SBA 504 has its own advantages. And SBA 504, one of the tricky bits is, you have to work with the bank. You have to get an approval from the bank. A certified development company, which is a local nonprofit licensed in your state. Let's say North Carolina, that's where I'm at right now. So a North Carolina certified development company, CDC, needs to review and underwrite your project and eventually send it to the SBA to review and approve your project. So it is a little bit of a process because you have to go to the bank, the CDC, and then eventually the SBA to know that your project has been approved. So it does take a little bit of time and patience and some paperwork to get it done. But the reason the process can be tedious is CDCs are local to the state. So let's say North Carolina has its CDCs. If South Carolina didn't have CDCs, the North Carolina CDC may be eligible to perform in the South Carolina markets. But every CDC in every state is different. So you never know what kind of performance you can get when you are approaching a CDC that you've never worked before. So service levels can be different in different states. So that is a little bit of the performance side of things that can be a hurdle. But most CDCs that we work with, we have a good relationship with, we have a good understanding with. They can process it fairly quickly because they understand where we're coming from. But at times when we work with someone new, we have to explain to them exactly how a self-storage facility works, and turn around assets, what they look like, and why we are comfortable with such projections and stuff like that. So it can be an educational process, but yeah, we still get deals done. 504 is definitely very popular these days because of the low interest rate. Now that's about it from me. And I'll open it up for questions now. And let me see. Start off my camera. There we go. All right. So in terms of questions, I've got one here from Kenneth Hayes. With the no bankruptcy requirement, if you filed back in the past and was discharged within a few months of filing, does it count against you? Like I said, the bankruptcy rule is specific to Live Oak Bank. It's not an SBA rule. So if you approach Live Oak, it may be a difficult transaction to get approved. But if you go to another bank that does not hold bankruptcy to that much weight as Live Oak does, then you might be able to get that deal done easier there. Now, all right, let's see. I know I covered a whole lot of information here today. If you don't have any questions at the moment, we can always catch up later, but we do have some time to go over some questions right now before our time's up. All right, I guess we don't have any questions at the moment. Like I said, my information's right there, and if you think of something at a later date or time, feel free to send out an email or give me a call. We can always talk about it. Oh, here we go. What type of rates are available via SBA 7A program? 7A, you'll probably get variety of rates. I mean, it depends, a variable, 3-year fixed, 5-year fixed, 7, and some do a fully fixed. But yeah, it all depends on what kind of project you have, what kind of guarantors are part of that project. But yeah, there's different rates available for the SBA 7A program. Same for the 504 first. Banks have different rates depending on the project. So the other question is, what's your preferred SBA, I take it, loan program for new construction in today's environment? Now it depends. If you want to put 10% down and get 90% financing, um, then SBA 7A would be the loan to go with. The SBA 7A loan, the reason you want to go with that is because you can get all those different items that I'd mentioned in my presentation, which is the cost to acquire the land, construction hard costs, soft costs, all of the loan closing costs, and the interest reserve and operating capital. Now, in the 504, what happens is you can include the cost of the land, construction hard costs, soft costs, loan closing costs, and interest reserve, but you cannot put in operating capital. So the operating capital gets left out, and that either is a burden that falls on the borrower, or you can get a third loan, an SBA 7A loan, on a 10-year term to account for that. If you do definitely need financing for your operating capital. So it all depends on which bucket you're in and what kind of financing package you need. If you have the liquidity to support the operating capital yourself, absolutely the 504 is the way to go. But if you want to preserve your liquidity, then I would say the 7A. Plus with the SBA 7A, it's going to be a little easier to get that thing and get the application processed. On the 7A side, you'll also get 36 months of interest only on that deal versus the 504, which you'll get probably 36 months of interest only on the bank piece. But when the debenture sets after construction, after CO, that's going to be on principal and interest payments. So your debt obligations right out of the gate, right out when you're leasing up, may be a little higher than the 7A. But at the same time, if you do lock your debenture in at the right time, you can get a very low interest rate. But yeah, the SBA 7A and the 504, although they are both SBA products, they do cater to different types of borrowers and their preferences to risk, to leverage, all of that. So, when I look at an acquisition or a development, I look at it through both scopes. I look at it through an SBA 7A scope and a 504 scope, and then I can usually present both the pictures to my clients, my borrowers, and say, hey, this is how this shakes out versus this is how this shakes out, and you pick and choose. That banks who are experienced and specialized in the SBA can do that for you, rather than just pushing you to one product versus another. So we have the flexibility to look at it from both sides. So yeah, that is, I think, something that would be helpful for a borrower, especially a first-time SBA applicant or a self-storage applicant, to understand what they're getting from each of the products. I do have another question. Does the amount of experience, time in the self-storage industry affect rates, terms at all? I have experience in real estate investing in general, but not specifically in self-storage. Is this a consideration? So like I said, the SBA program is there to help people access new industries. It provides the cushion to the bank so that they can lend to folks that would not in a regular day qualify for conventional financing. So the experience does come into play, but we're looking at, with an SBA scope, we're looking at folks who have transferable skills. So you mentioned that you have experience in real estate investing. That is a transferable skill, in my opinion. You've done real estate assets before. You know what is involved in taking down a real estate transaction. And if you're an owner, you know how to manage a real estate asset. So we take that into consideration when we are underwriting your request. The the terms may not be, the terms are set by the SBA. So if it's a real estate transaction, you get the 25-year term. Or the prepayment is set by the SBA. That's non-negotiable, whoever you are. That's how it goes. Rates, probably not. But again, as long as you show the bank that you are a serious candidate, you've done your due diligence. Here's my business plan. It highlights, everything that I would like to do. If that, if someone reads that and says, okay, this person has definitely done the due diligence, then we really don't need to count on prior self-storage experience or knowledge to do the deal. So again, I'm seeing some chats here where an individual was recommended to get more experience before applying. Now, you just have to be prepared. I think the due diligence that you provide to the bank has to really stand out. It has to really show us that you've done your research, you are ready to take on a transaction. So I would encourage anyone who's looking forward to getting a self-storage deal done to do your homework, put together a business plan that answers any question that the banks may have, and that would be testament enough to your drive, to your due diligence, to your to your future managerial style. So all that would be taken into consideration. All right, I think that's about it. In terms of time, I think we've used up all our time for now. Actually, you know what? Before we sign off, this is actually a very good question, Chandler. Thank you so much for bringing this up. Do plans to operate with a third party or franchise location affect financing at all? Third party, in this case, I assume is third party management. The third party management, the SBA did change its guidelines in 2018. So there's the REITs, unfortunately, are out at the moment in regards to third party management companies, but there are smaller management companies that are still eligible. It all falls down to the contract, the third party management contract, and how that is drawn up. The key situation that comes into play is the employees need to be employed by the operating company and not the third-party management company. That is a big hurdle that we've faced, and the SBA placed that hurdle so that the big REITs would not be eligible for financing, because that's just chaotic for them to place an employee that they've groomed and trained to just send it out to an operating company of an individual somewhere else. So that is a big hurdle point, but there are management companies. I know Absolute Storage Management, Atomic Storage Management, Platinum Storage Group out of California. All these are eligible third-party management companies, and that's only because their third-party management agreements are in compliance with the SBA. So the REITs, unfortunately, are out at the moment, but there are smaller third-party management companies that are still eligible to manage your facility through, even if you have SBA financing. The second question is about franchise. We do work with franchises like Storage Authority, and those are perfectly fine to use for your facility. All right. Let's see. I'm going to give another 2 minutes before we can adjourn. That'll be a 1 hour session at that point. So I think that's good enough time for today. But again, we can always continue this conversation at a later time via email or phone calls. And again, this session is recorded, so you can always access it afterwards, after our conference today. All right, thank you very much, everyone. Appreciate you guys joining this breakout session and listening to me. If you have any questions, I'll be available via email and phone call. Feel free to reach out. Again, thank you very much.